All right, let's jump right into the Q&A from LaZboy's latest earnings call. The analysts had a ton of questions, and for good reason. The company is making some huge strategic moves right now, and we're going to unpack what it all means for their future. So to make sense of a pretty complex conversation, we've broken it down into 5 key themes. We'll start with the Great Reshuffle, then look at the bottom line impact. After that, we'll see how they're navigating market headwinds, check out their new blueprint for growth, and wrap up with how they're funding the future. Let's get started. All right, first up, the Great Reshuffle. And this is the biggest news, for sure. LazyBoy is doing something pretty wild. They're buying a huge piece of their retail network and at the exact same time selling off other major parts of the business. It's a lot to unpack. So you've really got 2 big moves happening at once. On the inside, they're snapping up 15 really successful stores from their biggest independent dealer. This is all about growing their own company-owned retail. But on the outside, they're ditching their case goods businesses, the wooden stuff like dressers and tables, and they're also looking to close their UK factory. It really is a perfect example of addition by subtraction. And if you're wondering why they're doing all this, the CEO, Melinda Whittington, laid it out pretty clearly. She basically said, look, designing and making case goods from scratch, that's just not our core strength. They believe they should focus on what they're famous for, that custom upholstered furniture, and let other specialists handle the wooden stuff. It's all about doubling down on what they do best. Okay, so you see all this shuffling around, and the next logical question is, what does this actually do to the bottom line? How does it impact the finances? And the answer? Well, it's not what you might expect. Yeah, this was the big one. I mean, what is the net financial impact of all these deals? You're bringing in sales from the new stores, right? But you're also losing all the sales from the businesses you're getting rid of. So which one wins? The math here really tells you everything you need to know about their strategy. And here's the breakdown. The stores they're buying, that brings in about $40 million in net sales. But the businesses they're exiting, that's a $70 million hit. So you do the math, and they actually end up with a net decrease in annual sales of $30 million. Now, you might be thinking, wait, they're losing sales on purpose? And the answer is yes. This is not about growing sales, not right now anyway. It's all about improving their margin. They're making a trade, giving up some less profitable revenue to make the whole company healthier and ultimately more profitable. And here is the big payoff. This whole maneuver is expected to improve their adjusted operating margin by 75 to 100 basis points. Now, for those not in finance, that's basically a full percentage point improvement. And for a company this size, trust me, that is a huge, huge deal. Okay, so we've got the internal strategy down, but none of this is happening in a vacuum, right? The economy is tricky, to say the least. So let's talk about how they're planning to navigate these market headwinds. Right. So when analysts ask about tariffs, the company had a really clear playbook ready to go. First, their secret weapon. 90% of their stuff is made right here in North America, which is a massive advantage. Then, they're making some smart tweaks to where they get their materials. And finally, they might have to do some small, what they call nominal, price increases to cover any gaps. It's a pretty solid defense. The CEO also had this great way of describing the market right now. She called it a K-shaped economy, which I think is perfect. It basically means the market is splitting in two. You have the top part of the K going up. That's the high-end customer who is still spending big on design projects. But then you have the bottom part of the K going down. That's the more value-conscious shopper who really needs a good deal to buy anything. And trying to sell to both of those customers at the same time, yeah, that takes some serious laser precision. So once they finish streamlining everything and have their plan for the current economy, the next big question is pretty obvious, right? Where does the new growth actually come from? Let's get into their new blueprint for that. One huge piece of the puzzle is just expanding the brand's reach. They're teaming up with some big names. We're talking major retailers like Living Spaces, over 350 Costco locations, and more than 260 Farmers Home Furniture stores. The idea is simple. Get the LazyBoy name in front of a whole new set of eyeballs, people who might not think to walk into a dedicated LazyBoy store on their own. But it's not just about relying on partners. They're also revving up their own retail growth engine. The plan here is pretty straightforward. First, keep acquiring those high-performing independent dealers like we talked about. Second, build 10 to 15 brand new stores every single year. And third,
keep pushing that total store count up towards their big goal of over 400 stores. It's an aggressive plan.
Okay, so buying stores, building new ones, this all sounds expensive, right? Which brings us to the final piece of the puzzle. How are they actually funding all this? Where's the money coming from, and how do they keep their investors happy at the same time? Well, their basic philosophy is pretty simple. Long-term, they aim for a 50-50 split with their cash. Half gets reinvested back into the business to fuel growth, and the other half goes back to shareholders through things like dividends. But for right now, because of all these big projects, they've admitted they're leaning a little heavier on the reinvest in the business side of things.
But here's the kicker. Even while they're spending all this money on growth, they still announced a 10% dividend increase. That's the 5th year in a row they've had a double-digit hike, and that right there is a massive signal of confidence. It's the company telling investors, don't worry, we've got this, we are strong, and we believe this new plan is absolutely going to work.
So when you boil it all down, here's the takeaway. La-Z-Boy is making a really calculated bet. They're sacrificing some sales right now for what they hope will be a much more profitable, sustainable company down the road. And that leaves us with the million-dollar question, doesn't it? In this shaky economy, is this bold gamble on a leaner, more focused future actually going to pay off?